India. Prabhat, you have been quite overweight on the industrials, and it's a relief to see, at least in the IIP number gone by, that there's been a consistent improvement in investment, especially in capital goods. How do you play this theme now? Do you stick with the larger capital goods names, or do you even broaden your horizon to some of the infrastructure names in the mid-cap space?
We actually sort of been specific. So, it's a very broad sector. It has got many sub-themes that play out. But, we don't cover many of these infrastructure names. But I'm sure there will be some players out there as well. But we have been obviously more focused on themes which we believe are starting to play out, which might be in manufacturing investment improvements, or for example in railways, or in generalized, for example, Larsen we've been overweight on. So a generalized improvement and recovery, but it sort of encompasses all across, including sort of defense projects pickup, etc. So the cycle will be slow to pick up, first of all, because the sectors which drove it in the first place in the last 10 years might not be the driver going forward. So it might not be power generation in the first phase, but more like mining. Might not be, roads probably will be there, but railway might be a new sector which will drive it. It might not be metals and mining. So one has to be careful in terms of how one plays the cycle. One also has to be careful because obviously the sort of frenzy with which a number of companies build their asset bases meant that they, and I've said this before, they indiscriminately build their asset base, but obviously with a lot of debt, and which is now coming back to haunt them. So we are more sort of bullish on more asset-light companies and specific plays which play either the smart city theme or railways theme, or companies like L&T which have very decent balance sheet.
Okay, let me get back to that word you said on credit offtake and NPLs. You said NPL issues could recede and credit offtake could pick up. They normally go together. We hardly ever see all the NPLs getting wiped out. But as credit grows, they become a smaller part of the bank book. At least that's what happened in the 2003 cycle. Would you not worry that this time around they are handling a much larger problem, and credit offtake has been quite measly at below 10%? Can that actually play out? And if it does, if you're so confident, which is the bank that you would prefer?
So, obviously there is, the cycle is slightly different from last cycle. If you remember, Lata, the NPAs were not less in terms of percentage of, the assets, but it is the balance sheet structure which is different. Basically, the credit to deposit ratio is much higher this cycle than it was last cycle. They had bigger bond books in 2003, but the NPAs were actually larger. If you remember, some of the public sector banks' NPA ratios are closer to 15%. But what allowed these banks to write it off last cycle was...
If you count restructured, even this time it's getting to 15, isn't it?
Well, but the fact is that, to the extent that some of this is asset-backed and, not 100% will be write-off, you really can't take the full restructured books into account. So I think, taking the full restructured book, I think will probably be going to another extreme. So obviously there is a big problem that happens every cycle. But to the extent that it is backed by assets, you might have to take haircuts, but not the full restructured book will have to be written off. So I think I'll make a distinction. But anyways, I think there is. So last cycle you got a massive boost from bond books, basically, which allowed you to write some of the NPAs off. I think this cycle your NIMs are much larger compared to last cycle. So that's why banks are sort of slowly going to, well, this write-off process will continue. It takes about 2 years into a recovery before you start to actually see NPA levels stabilize. But they continue to recede slowly. So when you're sitting at the bottom of the cycle, it's very hard to make the judgment. That's the first point. The second point is obviously the banks, they're banks and banks, right? So yes, the PSU banks obviously have distress, but the private banks have been reasonably clear of the kind of problems that PSU banks have seen. And as far as the banking sector is concerned, when we look at the market, a large part of the banking sector capitalization resides in private banks, which have only 20% of assets of the entire banking sector. The growth comes back, these banks could grow much higher. The system growth comes back. That is what I'm saying. So I think as far as BankX is concerned, or when you look at the banking sector as represented in the market, I think the banks that we talk about, or BankX we talk about, actually is not in that bad a shape. as would be apparent if you were to just look at the overall assets owned by the banking sector. Even there will be improvement. That's the first point. Second point is on credit growth. Now, credit growth is obviously weak. There are three reasons for it. I think one, obviously, the commodity price fall also leads to, if you're seeing WPI in the negative territory, then obviously the working capital cycles will crunch, and that base impact is playing out at this point in time, right? If you sort of oil prices are down or steel is down, then inventory carrying costs can come down. Your working capital financing is not growing as fast, primarily because the sales growth itself is close to zero, right? So the working capital is not growing. But these are base impacts. They will play off, and as I said, the top line growth will start to come back as long as the real growth is picking up. There will be some inflation once these commodity price based impacts play off. So that is one part on the credit cycle. The second part is about so the working capital cycles will start to get better in terms of credit offtake. The second is about capex. Now capex obviously is an issue because when you were lending at much higher rate of capex formation earlier, and those guys are repaying or not repaying, whichever the case may be, but the fact is that you were lending at a much higher level of activity and you're lending lower today. So there is a repayment cycle is barely sufficient, or rather new borrowings are really barely sufficient to cover the repayment cycles. That's a process that takes time. So it might take about 1.5 years before that part of the cycle kicks in. And the third is about retail.
Okay.
Now the fact is that we are seeing commercial vehicles start to grow better. We are seeing cars start to go better, right? So that part of the cycle also will kick in. So on aggregate, this 10% I think is the bottom that you're seeing, because you've seen a lot of impacts built into this kind of number.
Okay.
I think you'll probably feel better about this about 9 months later, and that is where we think that the things will start.
Okay. Now to the short point, therefore, which is the pick of the pack for you in banks?
Well, we like. So as I said, the market representation is largely in private banks. Our picks have largely been private banks. We have sort of in our 6-7 stock portfolio, we've largely got all private banks like ICICI, Axis, HDFC, Yes, and IndusInd Bank. Then we had SBI in there, which is obviously has been better than the rest. And there are a couple of other banks. So in public sector, largely there are very few banks where we essentially have comfort. But there are, we think that BOB and UNBK have better balance sheets, but clearly as stocks they are also getting hammered. I mean, SBI obviously has been much better than the rest of them.
Yep.
But our concentration, 80% of concentration is in private banks, so 80-90%.
All right, Prabhat, we leave it at that. Thank you for stopping by and speaking about the market. So the exuberance in the market has definitely reduced, but they don't see any reason to scale down their year-end Sensex target of 33,500.